Good morning, good afternoon, good evening, traders from across the globe, and welcome to the 1876th edition of Short-Term Trading Live with Oscar. Good evening, traders, and good evening to the first video in 2019. Traders, as you know, this is an extremely risky business. Please know this. Markets have been extremely volatile. Never, ever trade without money. You can absolutely afford to lose. You can lose more than you're actually betting with, if you want to call it a bet. And know that if you do trade with money that you cannot afford to lose, you might lose your wife or husband or house, or maybe worse. Please use your heads when you're going to play this game, and certainly get your monthly subscription at livewithoscar.com, and I'll send you out my daily signals as the OMNI wants us to buy and sell. All right, traders, so the 1876th video is about a couple of things. One is a slightly longer term view of the indices, and then we'll have a slightly shorter term view of what we want to do for trading on Wednesday night through Thursday. So, because it's a slightly longer term view, I am here to tell you that we are not going to trade on Thursday. We are going to observe. Now, if you're saying, Oscar, are you kidding me? It was open already on Wednesday and you didn't trade. You're not going to trade Thursday? Well, we might trade something, but I'm here to say this, traders. Listen to me. We are not gamblers with an addiction. We're traders with a methodical approach. I don't care if you're anxious to trade. That's not why we trade. We trade when the market's set up. I don't see a perfect setup here yet, so we will not trade emini S&P on Thursday. We'll see what happens. We are looking very slightly at the Russell 2000, and certainly we are looking at gold. The S&P, I believe we will be hands off, so let me give you my slightly longer term view. This video is for trading on January 3rd, 2019, which is Thursday, but likely it's for trading gold more so than S&P, and here's why. You are looking at the weekly S&P bar chart, which means every one of these weekly bars, every one of these bars, I should say, and let me clean this up so I can show you what I mean. Every one of these bars is considered one weekly bar. So every one of these, whether it's red or green, is what happened in a week's worth of trading, as opposed to a daily bar, which then would show you each one of these bars would be a today's range, yesterday's range, day before's range. So this is this week's range so far, the red bar, last week's range, the week before's range. All right, so we are looking at a weekly, which makes it a longer term view. This is the 200 bar moving average, also known as the fund manager's blue light special. Generally, when fund managers see the S&P 500 hit the 200 bar moving average on a weekly or a daily for that matter, they tend to react. So here we are in 2018 through 2019, right now top day, and we bounced 150 points almost off of the 200 bar moving average. Makes me wonder, do we have a case to stand back, not trade, and see if we have put in some sort of a near-term bottom? We'll find out very quickly. For now, I'm going to watch, and here's why. So here we are, 2018-19. Market comes down to the 200 bar moving average, the fund manager's blue light special. Doesn't do that. Before that, last time we get to the 200 bar moving average is in 2016. And we're going to take a little ride here. The next time we get to the 200 bar moving average, we're in 2011. Then we bounce off of it. Look, just watch it. 2011, let me go forward now. We don't hit the 200 bar moving average again until 2016, and then top day, where we are today. So let's put another circle there to make it simple. Let's go back again. Here we are, 2016. As I showed you, we hit it. Even in the S&P Weekly, 2011, we hit it. We haven't breached it since 2008, 2009. This is the breaching of 2008-9, or the crash, if you will. of 2008-9. We breached it and broke. You don't breach it again until September 11th. The September 2001 event is the next time you breach the 200 ball moving average. And you get down through it. And down we go. So we're going to move along from 2001. We get down to it again, but we don't get through it. Right? We don't get through it, just a little. And we continue to move along. Here we are, 2008-9. We actually break it, and we have our 2008-9 crash. Boom, boom, boom. Boom, boom, boom. Crash. Now, we start drawing trend lines from the bottom of that crash. Note the gray trend line here. And once again, we get above the average, and we stay above, and we hit it in 2011. That trend line continues. We hit it again, as you know, because we've looked at this already in 2016. And look at the gray trend lines. Then we rally up, we take off, and we hit it again in 2018 into 19. And I am here to say, I'm not saying it's turned bullish. We need to step back and see if this is a repetitive pattern, which is about to repeat again, because, boy, does it repeat in the past. You know what I'm saying? It repeats in the past quite often. So that's the E-mini S&P. I'm not saying we've gone bullish. That's why we're not trading. Remember, this is a slightly longer term view. We're not going to trade tomorrow because we are not gamblers. We are traders with a methodical approach. We're going to take that methodical approach, collect data for another day in the E-mini S&P, at least another day, maybe for the rest of the week, and see what's going on here. Because if it is holding, we're entitled to some kind of a rally. Because each time it held, even after September 11th's crash, you were entitled to some kind of a rally. Which was going to, let me take you back to September 11th's crash. We hit it, rallied, broke it, rallied. Third time, we didn't have a chance to rally past it again. But you see, the first time we penetrated, even in 2008, we rallied up from it, hit it again, rallied further. So what I'm saying is maybe we're due for some kind of a rally here. Maybe short-lived, I don't know. Maybe it won't happen at all. But wouldn't it be a good idea to just sidestep this a little bit and see if this repetitive pattern wants to repeat? And how about we see if this trend line is going to also have some meaning? This trend line goes back to the crash of 11, if I remember right, the breakdown of 2011. And then we have a further trend line. Well, I'll make it a different color, which goes all the way back to 2009. Let's make that one red. These two trend lines, this one goes back to 2011. This one goes back to 2009. We're certainly nearing this 2011 trend line support. And remember the repetitive pattern I'm looking into with the 200 ball moving average. So that's on your weekly, long-winded, but I wanted to explain that. That's the weekly E-mini S&P. Look at this. Here's your Dow Jones Transportation Average. Now, another thing, just like the E-mini S&P, first off, the Transportation Average led us down here and generally will lead the major moves. It has hit the 200 ball moving average and starting to bounce a little. Last time it hit was 2015, 2016. Let's go back now. Doesn't hit again until 2011. And very briefly, 2011, 2012, really, right here. Then, till 2008, 2009, no breach of the 200 ball moving average at all. Right? Since when it hits it, no more breaching. It hits it and runs for a long time. Right? Little breach, runs and runs. There's a breach, but it's little for now. It's little for now. Look, for now, it's a little breach. So I cannot tell you that we're going to become bullish just yet. I'm telling you, I got my eye on this, though, for sure, as you should. My gift to you, if you're not paying attention out there, you analysts, especially fund managers, pay attention here. Uncle Oscar's pretty good at this stuff. So, you've seen the transportation average, which led this move. And what I think about what happens around that 200 bar moving average, or the fund manager's blue light special. You saw the emini S&P, which is the market. Now I'll take you to something else slightly interesting, at least in my view, and that's here. Look at the gold on a weekly. Now, if you recall this chart, I've used it in several videos, and I showed you when gold gets above the 200 bar moving average, it sure does respect it. And then when it breaks it, it sure does break hard. And when it finally gets above, it respects it. Didn't break hard enough. Didn't break hard enough. Sure did respect it. So lots of reaction is my point around your 200 bar moving average. Generally, in fact, lately, since, well, on this entire chart, if you look from here to here, we have an average. The average pop, once you get above the 200 bar moving average, is 1365, kids. Once you get above the 200 bar, you pop on average, don't forget, to about 1365, which is this price right here where my cursor is. On average, because we took the low, we took the high, we averaged, boom. You know where we're trading now? 1288. So 1292, 1288, 1290. We've got some room. We are way above the moving average. First, we got above the moving average. Now we're way above. But that's on a weekly. And it's a little more difficult to trade a daily trade based on a weekly chart. And that's what brings me to my daily gold chart. The daily gold chart, if you will, has, in my opinion, a very rounding bottom look to it. A very rounding bottom look to it. One penetration right here, of course. You can see that, right? We've got one penetration, but that's nothing when you're looking at a fine art and not a science. There's a penetration through it. So what? Market had a hiccup that week. But on average, on your daily bar, you're building some sort of a pretty little rounding bottom. You could have actually taken that rounding bottom and you could have made it smaller, and from about here to here, you could have called this a cup and handle. I could break it out for you, but I'm not going to drive you crazy. In any event, I like it. This could have been a cup and handle here, but let's just call this a nice rounding looking bottom. My OMNI is green, and we are going to go after a buy if we trade on Thursday in the gold market while we observe the S&P market and see what we want to do next. So I wanted to show you that. I'd love for you to get your monthly subscriptions at livewithoscar.com. So the moment I'm going to trade tomorrow in gold, I will send you a signal. You'll know when I'm getting in gold. You'll know when I want to get out of gold. You'll know where you should protect yourself if the market goes wrong. And you'll have me in a trading room to help you get through these trades. That you get 24 hours a day, 4 weeks each month if you take your monthly subscription at livewithoscar.com. Traders, that's it. Remember, the 200 bar moving average? Well, we're above that too in the gold. Nicely above it. Keep your emotions out of trading. One of the best things you can do, in my opinion, to help keep those emotions at bay is say this to yourselves every morning, every afternoon, every evening. And you know what that is. Stops are in. Emotions are out. Rock and roll traders, I will see you all at livewithoscar.com.